Hey everyone, welcome back to Corporate Decoder, the place where we dig into the secrets companies hide in plain sight and try to make sense of them without putting you to sleep. And boy oh boy, do we have a treat for you today. We are going to decode a company that is trying to clean up its act literally by recycling plastic. But are they really making a profit? Or are they just spinning their wheels? Let's find out. Today we are diving deep into the latest quarterly report from Sino Corporation. You might know them better by their stock ticker SCLAR. This report covers their financial performance up to the 31st of December 2025. Now, this is a company that operates in the recycling and environmental technology space, specifically dealing with plastic waste. They are based in Malaysia and are aiming to turn trash into treasure or at least into revenue. So, how did they do in this past quarter and the 6 months leading up to it? Let's look at the numbers. First, let's peek at their financial health as of the 31st of December 2025 and compare it to the 30th of June 2025. Their total assets grew from about $4.4 million to nearly $5 million. That might sound good, but here is the kicker. Their liabilities are a whole lot bigger. Total liabilities shot up from about $6.8 million to a whopping $7.8 million. So they have more debts than assets, which is a red flag. And their total stockholders deficit, which is basically what is left for the owners after all the debts are paid, is a negative number, meaning they owe more than they own. This deficit widened from about $2.4 million to almost $2.9 million. That is not a good sign for the owners. Now, let's talk about what they are actually selling. For the 3 months ending the 31st of December 2025, their net revenues were $278,161. That is a pretty decent jump, up by 58% from $116,936 in the same period. Last year, they say this boost came from selling more recycled plastic products sourced from other companies. They also managed to sell more to fewer customers, which usually means each customer is buying a lot more. For the 6 months ending the 31st of December 2025, revenues were $725,205, up 26% from $574,230 in the prior year. Again, this growth seems driven by selling more recycled plastic. But here is where things get tricky. While revenue is up, look at the cost of making those revenues. For the 3 months ending the 31st of December 2025, the cost of revenues was $367,796. This is almost the same as the $376,757 they spent last year. So, even though they sold more, their costs didn't really go down. For the 6 months, the cost of revenues actually dropped by 18% from $103,4524 down to $850,166. The report mentions this drop was partly due to better quality raw materials, and significantly, a credit from a previous inventory write-down being applied to the cost of sales. This means they are getting a boost from past mistakes or adjustments. This leads us to their gross loss. You see, when the cost of what you sell is more than the money you make from selling it, you have a gross loss. And for Sino Corporation, they have a consistent gross loss. For the 3 months ending the 31st of December 2025, their gross loss was $89,635. That's better than last year's loss of $259,821, but it's still a loss. For the 6 months, the gross loss was $124,961, a big improvement from $460,294 last year. This improvement is thanks to lower costs and higher sales, but it is crucial to remember they are still losing money on the core business of selling their products. On top of that, they have other operating costs like general and administrative expenses. These went up by 39% for the 3-month period to $111,453, mainly due to more travel and service fees. For the 6-month period, these costs also increased by 33%, reaching $232,276. So, while they are trying to increase sales, their overhead costs are also climbing. Putting it all together, the company is still losing money overall. Their net loss for the 3 months ending the 31st of December 2025 was $226,701. That is a decrease of 58% from the $358,644 loss last year, which is good, but still a loss. For the 6 months, the net loss was $412,951. A decrease of 40% from $691,975 last year. This reduction in loss is primarily due to lower costs and increased sales. Now, let's talk about something very important. Going concern. This is a fancy way of saying, can the company stay in business? As of the 31st of December 2025, the company has a massive accumulated deficit of over $5 million, a net loss of over $400,000 for the 6 months, and a stockholder deficit of nearly $2.9 million. This means their financial situation raises serious doubts about whether they can keep operating for the next year. Their own auditors have expressed this doubt before. It seems they are relying on getting more money from outside investors, cutting costs, and getting support from their holding company, but there is no guarantee any of this will work. Let's look at how they are handling their cash. For the 6 months ending the 31st of December 2025, cash provided by operating activities was a positive $817,693. This is a huge jump from the negative $188,039 in the same period last year. The report says this improvement is mainly because they owe more to suppliers and related parties for materials, and also because they received funding from investors. Basically, they are getting money from sales, and also from a mix of owing money and getting new investment. In investing activities, they used $71,617 in the 6 months ending the 31st of December 2025, mainly to buy new equipment and property. Last year, they actually had cash coming in from selling some assets. So, they are investing more now. Financing activities show they used $501,812 in the 6 months ending the 31st of December 2025. This is a big change from the $249,357 that came into the company in the same period last year. The report indicates this is because they received less money from loans and financial support from related parties. So, less money is coming in from borrowing or support. Let's talk about their inventory. As of the 31st of December 2025, their inventory was valued at $449,567, a significant increase from $175,142 6 months earlier. This is mostly due to a massive jump in the raw materials they have on hand. They did mention a write-down of $119,886 for inventory in the previous year, and then a write-back in the current period. This suggests they are having trouble selling their inventory or its value has decreased. Their property, plant and equipment, which are things like buildings and machinery, increased from about $4.1 million to over $4.1 million. The company bought a factory building for about $1.7 million in cash funded by a bank loan, which is a big deal. The report also details the useful lives of their assets, like factory buildings lasting 20 years and factory equipment about 7 years. They have not found any signs that these assets are worth less than what they are recorded at, which is good. Remember that convertible note for $750,000 we mentioned? Well, the person or company who lent them the money decided not to convert it into stock. So it is now just a regular loan. This means that debt doesn't become equity, so the ownership isn't diluted but the debt remains. They have significant bank loans with future minimum payments totaling over $2.2 million. These loans are secured by their factory buildings, meaning if they can't pay, the banks can take the factories. The interest rates are tied to a base lending rate, and as of the 30th of June 2025, it was around 4.06%, which is respectable. Now, a really interesting part are the related party transactions. They owe a lot of money to companies and people connected to their management. For instance, they owe nearly $3 million to related parties. This includes amounts owed to Luosheng and his spouse Kuqing, who own a large chunk of the company, as well as entities controlled by them. It means a lot of the money flowing in and out of the company is between itself and its owners or their other businesses. This can sometimes be a way to move money around, but it also means they are heavily reliant on financial support from these connected parties. Looking ahead, a key event occurred after the reporting period on the 11th of February 2026. The company entered into agreements to sell nearly 300,000 shares of its common stock in a private placement. This is a way to raise more money from investors, but it also means more shares will be out there, potentially diluting the value of existing shares. The management's discussion section is where they explain their results. They are proud of the revenue increase, but as we saw, it is not translating into profit yet. They acknowledge the increase in general and administrative expenses due to travel and service fees, which is a bit concerning as these are often areas where costs can be controlled. And here is a big one. The company admits its disclosure controls and procedures are not effective. They point to material weaknesses in their internal controls. This means there is a risk that financial mistakes could be made and not caught in time. They mention they lack a functioning independent audit committee and board, have poor segregation of duties, and not enough staff with strong US GAAP knowledge. This is a serious issue for any company, especially one that needs to inspire confidence in investors. So, what is the verdict on Sino Greenland Corporation? They are trying to make a go of it in the recycling business, and they did manage to increase their sales. However, The core business is still losing money, they have a lot of debt, and their financial reporting controls are weak. They are heavily reliant on related parties for funding and operations. The positive cash flow from operations is a good sign, but it seems to be driven more by how they manage their payables and get new investment rather than by strong, profitable sales. The big jump in inventory without a corresponding increase in profit is also a concern. The significant increase in liabilities and the widening stockholder deficit paint a picture of a company struggling to turn its operations into a profitable venture. The lack of effective internal controls is a major red flag for investors. While the increase in revenue is positive, it is not enough to overcome the costs and losses. The company's future heavily depends on securing more funding and improving its operational efficiency to achieve profitability. Without these, the going concern issue will remain a major threat. That is our deep dive into Sino Greenland Corporation's latest report. What do you think about their financial health and future prospects? Let us know your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more of these corporate breakdowns. And don't forget to join our Discord community, linked in the description, to keep the conversation going. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.